Thinking about buying a house but feeling unsure about which mortgage is the best fit for you? Don't worry, I've got you covered in this video. I'm breaking down all the different types of loans, explaining how they work, and helping you figure out which one might be perfect for your situation. Stay tuned. Hey there, I'm Nicholas Newcomer, your go-to real estate pro with eXp Realty right here in the beautiful North Carolina. Think about buying a home. You probably heard about all the different loan options out there, but how do you know which one is perfect for you? In today's video, we're diving into the most popular types of home loans, breaking them down in simple terms and uncovering why choosing the right loan and the right lender can make all the difference. First up, let's talk about lenders. When it comes to choosing a mortgage lender, going local can be a total game changer. Local lenders have a deep understanding of your housing market, property values, trends, and regional regulations, allowing them to close loans up to 20% faster with an average of 5 days quicker than larger institutions, according to Zillow and Ellie Mae studies. They offer a personal touch, with 93% of borrowers preferring the face-to-face interactions and accessibility that local lenders provide, making the process smoother and more tailored to your needs. Their strong ties with local real estate agents, appraisers, and title companions streamline transactions, giving you a competitive edge in bidding wars. In fact, 87% of real estate agents trust local lenders for their reliability. Sellers often favor offers backed by local lenders, and they frequently provide community-focused programs like first-time homebuyer incentives or low-down payment options. Beyond the practical benefits, choosing a local lender supports your community, contributing 23% more to the regional economy than the national banks, with faster service, personalized care, and a meaningful local impact. A local lender isn't just a smart choice, it's a winning strategy. Now let's dive into conventional mortgages, the most popular type of home loan in the United States, making up about 78% of all mortgages, according to the Mortgage Bankers Association. Unlike government-backed loans like FHA or VA loans, conventional mortgages are offered by private lenders and provide borrowers with competitive and flexible options. They fall into two categories: conforming loans, which adhere to Federal Housing Finance Agency guidelines, including a 2024 loan limit of $726,200 in most areas, and non-conforming loans such as jumbo loans, which exceed these limits. One key benefit of conforming loans is the ability to cancel private mortgage insurance, which you've built 20% equity, potentially saving you thousands over time. However, if you put down less than 20%, PMI will be required, costing between 0.3% and 1.5% of the loan amount annually, depending on your credit score and loan terms. Conventional loans typically have stricter qualification requirements, such as minimal credit score of 620 with the best interest rates reserved for scores of 740 or even higher. Additionally, borrowers generally need a debt-to-income ratio below 43% to ensure mortgage payments remain manageable. Flexibility is another part. First-time homebuyers can put down as little as 3%, while others may choose to pay 20% or more to avoid PMI entirely. These loans are known for their competitive interest rates, lower long-term costs, and fewer restrictions on property types, making them a go-to option for 60% of first-time buyers. However, they're best suited for borrowers with strong credit and stable financial situations, as they are less forgiving of financial challenges compared to government-backed loans, which with affordability, versatility, and cost savings opportunities. Conventional loans are a solid choice for borrowers who meet their qualifications. Let's explore the different government-backed loan options available: FHA, VA, and USDA loans, each designed to make homeownership more accessible for different groups of borrowers. FHA loans, backed by the Federal Housing Administration, are popular among first-time homebuyers, who make up 83% of recipients, according to HUD. These loans are accessible to borrowers with credit scores as low as 500 and require down payments as low as 3.5% for scores of 580 or higher. However, they come with mortgage insurance costs, including upfront premium of 1.75% of the loan amount and annual premiums between 0.45% 1.5% and 1.05%. Loan limits for 2024 range from $472,030 in most areas to $1,089,300 in high-cost regions. VA loans guaranteed by the Department of Veteran Affairs are exclusive to veterans, active duty service members, and certain National Guard and Reserve members. These loans require no down payment or private mortgage insurance, significantly reducing monthly costs through a one-time VA funding fee, typically 2.3% for first-time users, applies with no official loan limits and flexible terms. VA loans accounted for 10% of all mortgages originating in 2023 and have supported over 24 million borrowers since 1944. USDA loans backed by the United States Department of Agriculture are tailored to low to moderate income borrowers in rural areas, requiring no down payment and offering low fees, including a 1% upfront guarantee fee and a 0.35% annual fee. However, eligibility is limited to USDA designated rural areas, with these loans accounting for 5% of rural home purchases in 2023. Together, these programs open doors to homeownership. FHA loans cater to these with low credit scores or limited savings. VA loans offer unparalleled benefits to military borrowers, and USDA loans make rural homeownership a reality for low to moderate income households. Now let's move on to adjustable rate mortgages, a home loan option where the interest rate changes periodically, typically based on a financial index plus a lender-defined margin. Adjustable rate mortgages start with a fixed interest rate for an initial period, commonly 3, 5, 7, or 10 years, before the rate adjusts annually. This structure offers lower starting interest rates than fixed rate mortgages, with the average initial rate for a 5/1 is 5.96% in 2023 compared to 6.41% for a 30-year fixed mortgage, according to Freddie Mac. Many borrowers choose adjustable rate mortgages to save on initial costs, particularly if they plan to sell or refinance before the fixed period ends. First-time home buyers in high-cost markets and affluent buyers of luxury properties often favor adjustable rate mortgages for these upfront savings. In 2023, adjustable rate mortgages accounted for about 9% of mortgages originations, a significant drop from their peak of over 35% during the early 2000 housing boom, according to the Mortgage Bankers Association. While adjustable rate mortgages can provide savings during the initial period, they can come with risk after the fixed term. The interest rate adjusts annually, which can result in higher payments and potential payment shock. For instances, in 2023, adjustable rate mortgages borrowers experienced average annual increase of 1.2% after the fixed period, potentially adding hundreds of dollars to monthly payments. Rate caps such as a 2-2-5 structure, limiting increase to 2% at the first adjustment, 2% annually thereafter, and 5% over the loan's life, help mitigate these risks but don't eliminate them. Adjustable rate mortgages are ideal for borrowers planning to move or refinance before adjustments occur, or for those expecting interest rates to decline. However, for buyers seeking long-term stability, fixed-rate mortgages may be a better fit. By understanding rate caps, terms, and market trends, borrowers can determine if an adjustable rate mortgage aligns with their financial goals and risk tolerance. Finally, let's talk about jumbo loans, the go-to option for financing high-value property. These loans exceed the conforming loan limit set by the Federal Housing Finance Agency, which are $726,200 in most areas and up to $1,089,300 in high-cost regions. As of 2024, designed for buyers in expensive markets or those purchasing luxury homes, jumbo loans made up about 5% of all mortgages originations in 2023, according to the Mortgage Bankers Association. Buyers seeking jumbo loans face stricter requirements, including a minimum credit score of 700 to 740, a debt-to-income ratio below 43%, and extensive income documentation. Additionally, down payments typically range from 10% to 20%, and lenders often require borrowers to hold 6 to 12 months worth of mortgage payments in reserve. Despite these rigorous qualifications, jumbo loans offer unique benefits that allow borrowers to finance properties without being constrained by loan limits, making them ideal for high value or luxury purchases. prices. In recent years, their interest rates have become increasingly competitive, averaged 6.1% in 2023, comparable to or even slightly lower than rates for conforming loans according to Freddie Mac. Borrowers can also select fixed rates or adjustable rate terms to match their financial strategies. However, it's important to note that jumbo loans are not subject to the same federal protections as conforming loans, granting lenders more flexibility in setting terms and posing higher risk for borrowers. Popular in high-cost areas like California, New York, and Washington, D.C., jumbo loans cater to financially secure individuals with the average home price for borrowers reaching $1.2 million, well above the national median of $416,100, according to the National Association of Realtors. While these loans provide access to luxury properties and expansive financing options, they demand a strong financial profile and careful planning to meet their requirements. Thanks for watching. If you're on the hunt for the right lender, I'd be happy to connect you with some great options. Got questions? Drop them in the comments below or reach out to me anytime. I'm here to help. If you enjoyed this video, don't forget to like, subscribe, and hit the notification bell so you never miss a future upload. And if you're looking to buy, sell, or invest in the area, I'd love to be your go-to resource. Feel free to call or text me at 336-266-8976 or send me an email to nick.realtor@icloud.com. Let's make your real estate dream a reality.